Welcome to the Future 42 and thank you for taking the time to visit our channel. We pray that you receive this knowledge with an open heart and mind. Today we will be covering The 6 Rules of Getting Rich by Robert Kiyosaki. If you are not familiar with Robert Kiyosaki and his phenomenal body of work, let us officially introduce you to your new mentor. Robert is a businessperson, investor, and profound author. He has written 26 books, including the international bestseller Rich Dad, Poor Dad, which we covered in our earlier videos. This book has been so successful, it has been translated into 51 languages and is sold over 41 million copies worldwide. In this video, we're going to explore the 6 basic rules for investing and how to employ them by the same standards as Robert Kiyosaki has used throughout his life. Before we jump into it, please hit that subscribe button and click the notification bell so you never miss another life-saving gem. The first rule of investing, which is heavily promoted by Robert, is to use other people's money to invest. Robert Kiyosaki advocates the use of debt to invest, and he doesn't mean pull out your Visa or MasterCard and start buying NFTs or any other theoretical asset. On the contrary, he is referring to as the use of what we term good debt. The artistic beauty of taking a liability, which essentially is debt, and using it to buy an asset is an expert technique that most never think of employing. Taking a negative part from your liability column and moving it into your assets column is low-key one of the biggest moves in wealth development. This is a strategy that Robert teaches in most of his educational content and is the premise of the Rich Dad Poor Dad book. We recommend looking at part 1 of our book summary for a detailed overview at the link in the description below. Robert encourages us to use our assets to generate income from them while taking our liabilities and making them expenses for tax efficiency as the path to true wealth. This is the exact method used by many of the wealthiest real estate investors. Real estate investors like Donald Trump and Grant Cardone use this very method referred to as other people's money or OPM. This strategy allows financing real estate deals, minimizing personal risk, and at the same time being tax efficient to maximize gains. Using OPM or other people's money to finance debt means that you can write it off against taxes and reduce your tax bill, which is something we all should desire to do. The second rule is understand the 3 types of income. There is a reason the rich pay less taxes, and it directly correlates with the 3 types of income. The first type of income is earned income. This is the money you earn from your job, or your trading hours for dollars. The second type of income is portfolio income. This is where you're flipping assets for a profit. Common examples of this is buying shares low and selling them at a higher price, or buying real estate significantly below market value and selling it at or above market value for profit. The third, and in most cases the most profitable form of income, is called passive income. This is a playground for the rich as they earn profit while sleeping, eating, vacationing, and enjoying life. Essentially, you're still earning money without the requirement of your presence or investment of time. This is also referred to as cash flow and is one of the only forms of income that can genuinely get you to a wealthy status. This is the kind of income that legally bypasses taxes, but of course you would have to consult a tax professional for the specifics. We are not licensed tax professionals, so please do not make any decisions based on just this video alone. Combining the use of other people's money to generate passive income means that you can generate wealth while paying the least amount of tax. Therefore, operating inside of a business to buy assets and generate cash flow is the true path to wealth. Operating within a business makes you tax efficient and means that you get to keep more of what you earn, unlike a job. Not to mention, you are practically donating a little under half of your salary every year to the state and/or federal government, and I bet your tax preparer loves you the most. This brings us to the third rule. Get a financial education. Robert Kiyosaki is an activist for financial education that often quotes, "If you want to succeed in life and become wealthy, you must educate yourself financially." The schools do not and will not provide this level of literacy, so it is up to you to seek this education. The mere fact that you are watching this video means that you have already decided to invest into your financial future. Before you put in $1, you must be willing to pour in your time. You are now part of a small but growing community who dedicates the time to becoming financially free. If you want to learn more, then please hit the like button and subscribe. It really helps us to continue providing this knowledge. Schools teach you to get a job, pay taxes, and conform to normal society, but jobs are disappearing as we saw during this pandemic. Workers are being replaced by robots and artificial intelligence. Yet taxes, as well as inflation, continue to rise, utility bills and the cost of living continue to rise, and it doesn't look like it's going to stop anytime soon. For people in this society who are on a fixed income, the people who have a job, they are approaching the poverty line at a rapid pace. Did you know that job stands for just over broke? We haven't found it officially in a dictionary anywhere, but it makes the most logical sense. The government wants you to stay just over broke by paying them enormous amounts of taxes and keeping you in the rat race of working for earned income and paying taxes. Is this what you envisioned for the rest of your life? Do you see yourself ever becoming financially free? Would you prefer to continue to worry about household bills, rising costs, fuel prices, and inflation? We that you start working towards never having to worry about these things again. It's on you to get financially educated, so read as many books as you can and watch as many of our videos as possible. We will continue to feature teachings from our favorite investors and business people to make sure that we deliver the best knowledge on this key subject of finance. Just like and subscribe to our channel and stay tuned. The fourth rule: invest to gain cash flow. Most people in America want a high-paying job, to live in a big house and drive around in a luxurious automobile. This desire is single-handedly the cause of why 88% of Americans do not have money. They view earning money from the wrong perspective. Our society is training to master getting a nice salary at a job, working hard for a raise and grinding for that earned income, then most of it escapes in taxes every pay period. We need to be thinking in terms of buying assets rather than earning money. Remember what JOB stands for? Just over broke. You need to be investing in assets that produce cash flow, like real estate, for example. Instead of focusing on income, please start trying to obtain assets and set up sustainable gains. The passive income way is the only way to ensure that you take back your time. Every minute of every day, your investments in the asset column of life provide you with an income and a cash flow to live your best life. The more assets you can buy, the more income you can generate. That's why the rich get richer, and the poor get poorer. When you have a large amount of assets supplying a constant flow of income, only then are you truly financially free. Real financial freedom is when the income generated from your assets covers all your liabilities. You need to create this shift in your mindset from work income to asset cash flow. This is the secret sauce for cooking up financial freedom. We bet that you didn't learn that in school. Fear not, we'll teach you all that you need to know right here. The fifth rule: believe that investing isn't risky. When you look into a mirror, you don't doubt if you are seeing yourself or not. This is because you have been trained to understand that a mirror's whole purpose is to provide reflection. Using that same premise, you must learn that investment's whole purpose is to make money. When you see an investment opportunity, you must look at it only for its profitability. Do not invest in something because you believe in the owner, or the potential exposure, or any of the emotional aspects that are sold to you in the presentation. If it does not make money, then it does not make sense. Emotional considerations are the true risk, not the investment itself. The stock market fluctuates on sentiment and human emotion. If the stock market were traded by robots rather than humans, the true value of each of the companies traded on the stock exchange would be the true value of their actual worth. You would not have undervalued or overvalued stocks because the companies have been researching real figures and the true value of the company is derived from that analytical information. The stock market is all over the place. An opportunity exists in the market purely because people do not do their research and they buy and sell shares blindly. This creates undervalued and overvalued stocks. If you do your research into these companies and do some due diligence, you can find the overvalued or undervalued stocks. However, humans are inherently lazy, and they just want a quick buck. So, they blindly follow popular shares or ill-advised advice of fake gurus trending on social media. In a nutshell, stop trying to convince yourself that investing is risky. Stop listening to the masses that live in a state of fear just because they have been conditioned to do so. Do your own research on anything that you decide to put your time and money into, and you will see clearly what is for you and what is not for you. Market conditions and their tolerance to risk in the short term reveal the pattern of the stock market as it is constantly rising and falling in waves. This is normal and you need to be okay with this fact. If you're in it for the long term, which you should be, then history has shown us that on average over a long period of time the value of the stock market increases by around 8 to 10% per year. Some years it will be down 10%, but other years it will be up 20%. All averaging out in the end, the markets are on an upward trend, so think long term, not short term. The sixth rule and final rule: learn to evaluate risk and reward. As you look deeper into making your own investments, it is important to learn to evaluate risk and reward. In the book Rich Dad, Poor Dad, Robert uses the example of a nephew looking to create a burger stand business. He raised the question of, if you had a nephew who had an idea for creating a burger stand business, and he needed $25,000, would that be a worthwhile investment? Those that read the book would remember that the answer was no, as this is far too much of a risk for far too little a reward. He goes on to say, but what if I told you that this nephew had been working for a major burger chain for the past 15 years, has been the vice president, involved in every important aspect in the business, and is ready to go out on his own and build a worldwide burger chain? The opportunity is to buy 5% of that company with a $25,000 investment. Would that be interesting to you? The answer should be yes, because there is far more potential for gains for the same amount of risk. This example illustrates how important evaluating risk and reward can be and how important developing such a skill can be to your financial future. If your plan is to start creating real wealth in your life, then using the methods we have discussed in this video is imperative. Learning and eventually mastering the rules of investing is a lifestyle and mindset commitment. Watching a few videos is not enough, you need to decide right now that you are ready to embark upon this journey for financial and investing education. Watching videos like this is a huge leap and nothing to shrug a shoulder at. Give yourself a pat on the back and recognize that you are one step closer to the dream. We are committed to supplying the best quality videos through simple explanation and animation, so check out the next video to keep on building your financial knowledge. Be sure to subscribe and please share this video with a friend who is interested in financial freedom.